Yeah, Dan, are you there?
Yep, I'm here.
Okay, great. Then I'm going to get started here on the webinar. I want to thank everybody for joining today, and we have a special guest today, Dan Hanford of Hanford Capital, who's going to come on in just a few minutes and really give us a little overview on multifamily investing fundamentals. Now, if you're listening to this presentation live today, you have a question box. You can type questions in for either Dan or myself to answer for you, either whether it's on the IRA side of things or on the multifamily, what Dan's going to talk about here in just a minute. So just a quick overview, kind of my name is Scott Maurer. I'm the education and director of business development here at Advanta IRA. I'll be helping moderate today's webinar, provide a little bit of information on the IRA side of things. I'm a licensed attorney. I don't do any legal work for Advanta, but I've been with the company a number of years now, helping people invest through their self-directed IRAs and teaching people about how you do that, what the rules are, and what is involved with a self-directed IRA account. Started off early. That was back at the height of the real estate boom for those of you who were investing back at that time. And have been with the company ever since. And again, really focus more of my time nowadays on really educating people, educating professionals as well about self-directed IRA accounts, what's possible, what the rules are. One quick disclaimer we always have in our webinars and any presentations we do is that at Advanta IRA, we don't provide any legal tax or investment advice. We also are not affiliated with any company, even if we have people on as a guest like we do today. We're not affiliated with any particular company. We don't endorse any products or investment structures. We exist really to hold your self-directed IRA and invest at your direction. We can certainly refer you to legal tax, CPAs and attorneys to help you make decisions. When it comes to the investments you're considering in your self-directed IRA, and certainly refer you to people who help you do your due diligence on whether an investment is right for you. That's, again, not something that we do at Advanta. But what we do like to do is provide educational value. That's why we brought Dan on today to share his expertise. He'll be on it in just a few minutes for the presentation. For those of you who are on the webinar, have not heard of a self-directed IRA before, maybe why you haven't is simply that most retirement accounts are held with a brokerage firm or a bank who offers you the ability to invest in their products, whether it's mutual funds, stocks, bonds, those types of assets. IRS regulations really do allow for a much broader range of investments. And it's up to you to decide that you want to make that choice, and you can move the account then to a self-directed IRA. So IRS regulations allow for a lot of different investments, but it's up to each custodian to determine what it is that they're willing to hold. And in Advanta, we will hold a lot of different assets, kind of the things that the brokerage firms shy away from. One of which is multifamily real estate, and really all types of real estate as well. So IRS regulations allow for it, but your current custodian doesn't, and they're certainly not going to advertise to you that you can take your money away from their firm and go invest in other assets. That's why most people don't know, is simply they haven't been told. They certainly haven't heard about it because their current custodian is not going to let them in on that secret. Now, why are self-directed IRAs a good capital source? So if you're looking to raise capital for your next investment, it's good because if you're already working with other investors, you already have people who are buying into your products and projects, you can simply go to those existing clients and show them a way to use their retirement funds to invest in a property or invest in your next deal. It's, again, most people don't know that it's possible. It's a matter of just simply introducing the concept to them. So that can be a good, self-directed IRAs are a good capital source from that perspective of just going to your existing investors and having them reinvest with you to use your IRA account. And certainly for those people who are looking to invest their own IRA account, you can buy the same type of asset with your IRA that you buy personally. So if you buy vacation property, vacation rentals on the beach, or you like to buy condos or single family homes, you want to invest in multifamily, your IRA funds can certainly be used as well. IRAs are also good. Most people, when you're looking to make these investments that are not as liquid into, again, a multifamily syndication, or you're buying a long-term rental property, your IRA funds are going to be tied up a little bit while that asset is there. Most people do not expect to touch their IRA until they reach retirement. So they're not opposed necessarily to putting their IRA into a longer term investment that's a little bit illiquid. They use their savings account as their rainy day fund for emergencies. And the IRAs and 401ks are generally the last funds that they will tap into. So those accounts, again, can give you the ability to open up more capital if that's what you're looking to raise for your next investment. You can certainly offer your clients better returns than they're probably getting in their current IRA that's sitting in a money market or a CD, or people who are just afraid of the stock market. Figure there's a correction coming at some point. There always is. Let's get that money into something else I can control. And even better, there's no outside approval needed. So if you're talking to an investor, someone who wants to place funds into your next project, you simply need their approval. They can direct the IRA funds. They don't have to go to a bank. They don't have to get approval from their financial advisor. It's simply a matter of just making that decision to move forward with their IRA account. Just if you're looking why Advanta IRA, some of the benefits about what we do, we handle all the record keeping and custodial functions for your IRA. We don't have a lengthy approval process for investment paperwork. Our role is to make sure that if you're buying an asset in your IRA, that the paperwork is titled correctly, that you've approved it, and then ultimately we fund the investment and then do all the record keeping going forward. We've been dealing with real estate investments since we started back in 2004. We give you a private account manager, and we try to make the process as streamlined as possible. Very easy to understand. We do a lot of educational events. The one we're doing today is simply one of many that we typically will do in a given month to really help everyone, whether you're a client or looking to become a client or just want to know what self-directed is about, really just making sure you're comfortable in giving you that information to make the right decisions and understand what that process is. Now, just very quickly, the types of accounts that can be self-directed, any type of IRA, whether it's a Roth IRA, traditional account, if you're self-employed and have a simple or solo 401k, and certainly any old 401k, old 403b plans. Those can also be self-directed as well. It's something that gets missed from time to time. Individuals don't realize that you can use those former plans in order to make the investment. So you leave your employer, it's been sitting there for a while doing nothing. Those plans can be rolled over into a self-directed IRA as well. Moving the money is very simple. It's a matter of completing either a transfer or a direct rollover. So you can, if you have money in an existing IRA or an old 401k, you can roll it into a self-directed IRA. There's no tax consequence for doing so. It's a matter of just filling out the right paperwork and making sure the funds move in the proper direction. And that is also something that we will assist you with at the very outset when you're getting your account set up and making sure you get the right documents, send them to the right places, and get those funds moved. Again, when you're moving money between IRAs or from an old 401k to an IRA, there is no tax consequence, no penalties for moving that money. And in fact, you can do transfers and direct rollovers in partial amounts. It is not an all or nothing proposition. So if you have a $500,000 IRA and you want to carve out $100,000 to put in your next real estate deal, you can do simply a transfer of that particular amount. Now, the types of assets that we see at Advanta are, especially when it comes to real estate, all over the map. Anything from long-term rentals of, single-family homes or condos, could be short-term rentals, or certainly could be a rehab project. These are, obviously, this is more a situation where your IRA, it's your account, you're buying this property on your own, looking to make that investment. We also see individuals do private notes and mortgages, having your IRA be the bank and be a lender from your IRA account and lend money to somebody else and have them sign a note and mortgage. Mobile homes, parks, the checkbook control entities. For those of you who are familiar with self-direction, you've probably heard the term checkbook control IRA. We handle those as well. And again, these are some of the investments I'm going over now. We have deeper and longer webinars, obviously, on those particular topics. So check out our YouTube page for those. Tax liens, real estate investment trust. And then, of course, what we're going to talk about today, the syndications, the private placements, and people getting into multifamily property, commercial real estate, apartments, etc. The common thread with all of these real estate assets, again, and going back to a couple slides ago, brokerage firms will not hold these assets in your accounts with them. That is not their business model, is not something that they are interested in doing. It simply doesn't fit it. They won't do it. Doesn't mean you can't do it. Just means you have to have a custodian like Advanta who's willing to hold that asset. So today we're going to be talking a lot about multifamily. And we have Dan Hanford today of Hanford Capital, who's going to go over some of the multifamily real estate investing fundamentals. Dan, are you there?
Yes, I'm here. Can you hear me okay?
Yeah, I can hear you just fine. So yeah,
Great.
thanks for coming on today. Yeah, why don't you just
Awesome.
like I said, let me know. Let me know when you didn't need to move the slide along, and we'll keep it going.
Sure, that sounds good. Well, Scott, I want to, thank you as well for inviting me back. I know we did this a couple of months ago and had some great feedback on both sides of from your side as well as mine, and felt like it was good for us to kind of do another one of these because it's very important, I think, for people as they're considering their self-directeds and where they're going to put their money to, think about this multifamily route. So, thank you again for having me.
No, absolutely. I'd love to have you on. I mean, and I can tell you, Dan, we've gotten a lot of interest in the last few months. People, I think multifamily is really kind of hitting another level here of interest. And that's why we have had a few webinars on that. And we had you a couple months ago and wanted to have you back on. So I look forward to it.
Great, great. Well, I want to, first get started, and today on the webinar we're going to be talking about some of the fundamentals as it relates to multifamily real estate investing. Because as a passive investor, or what they call an LP, or a limited partner, you need to understand certain things before you start to invest in various projects. So I'll first start by kind of just explaining what we call what is called a multifamily syndication. So on the previous slide, you saw the types of assets that Advanta can hold in your self-directed IRA, and one of them was those syndications. And a syndication is a form of investing where you have a sponsor or a GP, what is called a general partner or operator, that's putting the project together. So they're going out and they're sourcing the deal. They're working with the brokers and the lenders and doing all the heavy lifting. So you, as a passive investor, do not have to worry about that particular aspect of it. And in order to be able to acquire these assets, they do what's called a syndication model, where multiple investors will come into each one of the deals and be able to participate in the upside of the deal. And so, to give you just a quick example, we did a project a couple of months ago where we had a $8.9 million project, and we raised 2.5 million for it, and we had around 35 investors in that project. The minimum investment in that deal was $50,000. We had some people come in at 50,000. We had some come in at 250,000. I think one person even brought 500,000. So really, is nice, because however much that you feel comfortable investing in each one of these projects is available to you. And instead of having to figure out how to come up with 2.5 million to be able to invest in these larger multifamily assets, which is what our group does and does these syndications, you can now put a smaller investment into each one of these and diversify across multiple properties to allow yourself to be able to have more opportunity for growth of your IRA. And this webinar today is with Advanta, so we're talking about how to invest in multifamily with your self-directed IRA. But this is also available for people who have just cash outside of their IRA that they want to invest, or they're maybe afraid of the stock market, or they have some money in the stock market and they want to pull that out and put it into more of a little bit of a safer, in my opinion, a safer investment vehicle, which is this multifamily real estate investing. So let's go to the next slide here, Scott. I want to give you a little bit of a background about myself. So again, my name is Dan Hanford. We actually just changed the branding of our company from Hanford Capital to a company called PassiveInvesting.com. And I'm one of the managing partners of that group. We have two other partners in that group. One of them is Brandon Abbott. He's our acquisitions lead. He goes out, sources the deal, works with the brokers, finds the assets, and then his background is in property and casualty as well as construction, so he has a very good background there that supports us. And then our other partner is Danny Randazzo, and he is our financial lead, and so he does all of our financial analyzing, our underwriting, our due diligence, all of that kind of stuff. He loves spreadsheets, so it's good to have someone on your team that loves spreadsheets. So he loves the spreadsheet side of things. And then my role in the company, PassiveInvesting.com, is to work with our investors and have them understand exactly what they're investing in, but also to be able to work with people that are that have goals for investing, to see if we're a good fit, because we're not a good fit for everybody. There's like Scott said earlier, when you invest in these assets, it is an illiquid security or an illiquid asset, meaning that you can't just press a button like you can in a stock and sell it. So you have to understand that this is going to be a longer term play, most of the assets that we acquire, we're going to hold for about 5 years. So I'm also, just a little bit more about my background, I'm the owner of 5 specialty non-surgical orthopedic medical clinics in South Carolina. And I also have investments in a little over 130 million worth of multifamily real estate assets, primarily multifamily with 100 units or more. We have one in our portfolio that's 33 units, and then the rest of them go over 100. So our portfolio consists of a little over 1,300 units. And I'm also the founder of a group called Multifamily Investor Nation. And Multifamily Investor Nation is designed for people who might want to have a little bit more of a hands-on role in acquiring these types of multifamily assets, where I go through and do weekly webinars and teach people, these multifamily syndicators and sponsors, how to put these deals and structures together. And so if that's something you're interested in, you could join us there. We also have a podcast called the Multifamily Investor Nation, where we actually interview people who are acquiring these assets, and we're figuring out how they found them and how they worked with the lenders and the brokers and the financing, and all the way to the closing table. And then my wife and I actually have a podcast called Tough Decisions for Entrepreneurs. So I have, these 5 specialty medical clinics, and I have the multifamily, real estate business, but I also have a couple other businesses that I have, started from scratch, and have done multiple 7 figures of revenue in each one of those businesses. And so my wife and I, about a year ago, decided to start this podcast together called Tough Decisions for Entrepreneurs. And it's a daily podcast. So every day we're releasing an episode, and we interview people and entrepreneurs about some of the tough decisions that they make in business. So if you like business, you'd like to hear about that kind of stuff, I'd encourage you to jump on that. So let's go to the next slide here, Scott. This next slide, I like to always show a little bit about my family. I think it's really important to understand, if for some reason you're going to be listening to somebody or learning from somebody, that you realize that they're a real person, and that they and who they really are. And so I always like to show this. You can see here, this is my wife and our 4 children. So on the in the middle of the screen there, kind of front and center, is my son. This is actually him. We went to Denver, Colorado last year, and he joined me to speak on stage at an event in Denver. And then you can see my wife on the right-hand side there, as well as on the left, and then the bottom left as well. But in the left-hand side, you can see my daughter, Callie. She's our 1-year-old. In the bottom right, you can see our 2-year-old. She's actually 2.5 now. That's Chloe. And if you look really closely, you can see that on her lap there, she's actually looking at the Jacksonville, Florida multifamily report. So she was in the back of my car, and she saw that after I had just got back from a trip to Jacksonville, and then had that there. And so she was having a good time looking at the pictures there. And then on the left-hand side there as well, to the left of me, which is to the right of me, if you're looking at me on the screen there, is my oldest daughter. She is 8 years old. So we have 4. We have an 8-year-old girl, 6-year-old boy, 2-year-old girl, and a 1-year-old girl. So we're definitely very, very busy. But I do have a wonderful wife who supports me in many different ways, and it helps make my life a lot easier as well. So that's a little bit about my family. Let's go to the next slide here, Scott. And so I wanted to cover a couple of things as to why multifamily might be a good asset for you to invest in. Number one, it's one of the most recession-proof investments, in my opinion. And if you look back in 2008, when the market crashed, the average default rate in the various asset classes, it might seem low to you, but it's actually fairly high for this. But it was 4%. So there was a 4% default rate back in 2008 for the various asset classes. Multifamily, though, had a 0.4% default rate. And it's because whenever the market turns, and you have a down economy, people are having a hard time buying homes. So naturally, what do? They go and buy apartment. They don't buy apartment. That's what we do, right? They go and rent an apartment, because they can't afford, or they can't get a loan to be able to get a house, and so they are forced to rent. And so that's one of the reasons why multifamily is a safe investment. And it was actually, even though it had a 0.4% default rate, it was the asset that recovered the fastest in 2008 as well. And so, as long as you could have you planned properly, and you were able to hold on to the asset through the downturn, right now you're doing phenomenally well. And it's because of the fact that people always are going to need a place to live. And if you look at the statistics right now, between now and 2030, the supply is not going to outpace. I mean, the supply is not going to outpace the demand. So we're going to have a lot more demand and not enough supply. And what that does for us as investors is it creates a demand. And whenever you create that demand, you have more people wanting an apartment than you actually have, and so you're able to raise the price of the apartments, which allows us you to increase the rents. And when you're acquiring these assets, you're buying them based off of their net operating income. So the higher that net operating income, the higher the exit's going to be, or also the higher the entry would be, depending on which way you're looking at it. But the other nice thing about these assets is that you have capital preservation. So when you invest in the stock market, if any of you had stocks in 2008, you probably realize that almost overnight you lost 30, 40, 50% of your investment. And a lot of that was that initial capital. And so it's going to be it's very hard when you're investing into a piece of real estate that it's going to all of a sudden just tank to zero, right? It's very hard for that because it's a hard asset. It's real estate. So you have inherent capital preservation when it comes to these investments. And I also think it's one of the most multifamily investing is one of the most forgiving assets to invest in as well. Now, for those of you who are considering this for your self-directed IRA, there is the potential for your self-directed IRA to double approximately every 5 years. Most of the assets that we acquire, we're going to hold on to them for 5 years, and then we will move that money or that we will exit that deal. And then for those of you that wanted to stay in that deal, we could possibly do a transfer into a different property. But when you compare this to something like stocks or mutual funds, annuities and REITs, those real estate investment trusts, you're not going to be able to get that kind of appreciation in your IRA. If you look right now for the last 5 years in your IRA, did you start out with 250,000 and then now 5 years later you have 500,000? Chances are, if you're not investing in something like multifamily or something outside of the typical mutual funds that most people invest their IRAs in, you're probably not. You probably might have grown maybe 5 to 10%. That was pretty much it. If you're lucky, right? Because we try to be very, very conservative with those when it comes to investing in some of the mutual funds. But with our assets, when we do an underwriting on our projects, our goals are to acquire assets that can go from about 1.9 to about 2.1 equity multiple, meaning you invest 100,000, you're going to get 190 to 210,000 within 5 years. And a lot of times right now, we're able to exit projects sooner rather than waiting the full 5 years, and we're hitting those returns sooner rather than later, which is always nice as well. Now, the other thing, like we talked about earlier, is that if you have non-IRA cash that's available to invest, instead of investing in stocks and bonds and mutual funds that are outside of your IRA, you can now use these types of multifamily assets to invest in and create yourself some passive income. So if you think about that, each one of these projects that we're putting together, or we're going to talk about some of the terminology, so don't get caught up on the terminology right now, but there's this thing called cash on cash return. So that allows us to kind of determine how much money we're going to make on the project from the initial investment. So most of ours are going to be anywhere between 8% on the low end up to about 11 or 12%. So if you look at that, let's just say we're in the middle of the road there. We're at 10% cash on cash return on that initial investment. If you put in $100,000, then each year while we're holding on to that investment, there should be a return to you of about $10,000 a year. So you can kind of do the math. If you put in $1 million, you're going to be at $100,000 a year in that income. And you can kind of do the math in your head when you start to talk about that cash on cash, which we'll define that a little bit further in a couple of slides here in a few minutes. Now, when you're investing in a self-directed IRA, some of these tax benefits that I'm going to talk about don't necessarily apply as much, but obviously talk to your CPA, talk to your tax advisors. I'm not an attorney, I'm not a tax advisor, I'm not a financial advisor, so this is purely for educational purposes. But for those of you who are investing some non-IRA cash, there's 3 types of depreciation that is really, really beneficial right now for for investing in real estate. Number one, you have your straight line, your standard depreciation, which is when you buy and acquire an asset like this, you're going to be able to take that asset and depreciate it over the standard depreciation schedule of 27 and a half years. And when you do that depreciation over that 27 and a half years, if you want to do what's called accelerated depreciation, when you get to these larger assets where we're acquiring these 100 units or more, we can do what's called cost segregation. Cost segregation is where you have an outside engineer firm, you hire an outside engineer firm to come into your property and piecemeal it down to the sheetrock and the studs and the flooring and the appliances and the countertops and the cabinets, the doorknobs and the light fixtures. And you can now accelerate so that depreciation, instead of waiting 27 and a half years, you can front load it to 5 to 15 years, depending on the item. And so we can front load that depreciation on the front end. And then you also have what's called bonus depreciation. Now, bonus depreciation, before the recent tax changes with the Trump tax law, we used to have what's called a 50% bonus depreciation during those first 12 months of renovation costs. Now, with the new tax law, he's changed that to 100% of the renovation of certain items in the renovation costs. You can 100% depreciate them the first year. That is phenomenal for investors because we can now be able to show more losses on these investments, which allows us to offset, have the potential to offset other passive income or other ordinary income, depending on your tax classification status. And so to give you a little bit of an example, I was going to show you this example on the screen, but I didn't have a chance to get it in the slides when I was thinking about this. But I just got the K1, but myself, I'm an investor in a project from last year. We closed on it in December of last year, and we owned it for 2 weeks. And I actually have a K1, which at the end of every year you get a K1 showing you how much money you made or lost. And on these assets, because we're using depreciation, we're getting depreciative losses. And so I actually showed a loss of just over $260,000 on this investment, which is phenomenal because of my tax classification status. I'm able to offset my income based off of that loss, which allows me to reduce my taxable liability. And those are the types of ways that's one of the ways that Donald Trump uses to reduce his taxable liability to zero. Love him or hate him, he's a smart businessman when it comes to taking full advantage of the tax laws. And when you think about the tax laws, they're actually created for wealthy people, and not because they're created to give more advantages to wealthy people. It's to incentivize wealthy people and people who have money to invest it instead of just sitting on it. Because if you didn't have the taxes here, the tax advantages, wealthy people would just take that money and just sit on it, just hold it and do nothing with it. But now they can take it and invest it, and it helps to reduce their taxable liability in other ways. So let's go to the next slide here. This is the historical returns that are that show less risk and better returns, what you call stocks or bonds. So you can see it here. You have you have your real estate, you have your stocks, and then you have your bonds. And so if you look at the down years, you can see that of how many down years real estate has had in the green there, how many down years the stocks have had, as well as the bonds. And if you look at this closely, you can see that real estate has had phenomenal up years. They've had more up years than stocks or bonds together. Okay. And so when you look at this is screaming real estate. So if you don't do something in real estate, you're missing the boat. But a lot of reasons why people don't do real estate is because it takes time. And they a lot of times are busy professionals, or they're retired and they want to go vacation, and not just vacation. They want to go travel the world or visit the grandkids, or do various things that they've been wanting to do because since they've been working all their life and now they're retired, but they don't want to sit there and have to worry about managing an asset. Well, that's why multifamily syndication is there, is because now you can use the vehicle of multifamily investing via a syndication model, and put that money to work while you're going out and doing whatever you want to do, and then you don't have to worry about that particular real estate investment, but you're able to take advantages of the upsides of it as well. So let's go to the next slide here. One of the other reasons why I like multifamily is because of home ownership that is significantly dropping in the United States. And this dropping of home ownership partially is because of back in 2008 when the stock market crashed, we had this huge bubble, but it's also because we're now getting to the point of these millennials that are now graduating college, and they want to be able to be more mobile, and so they're renting more than they are buying homes. And even when you have in migration from people across from other countries that are immigrating to the United States, a lot of them are renting instead of owning because of the inability of them right now to be able to get home ownership. And so you see a drop in home ownership, which is really good for multifamily because we are becoming a nation of renters, which is that next slide. That next slide is talking about how we are a nation of renters. It will continue, and it's going to continue to grow as a renter nation. And if you go to, there's a website, I don't have it on here, but there's a website called weareapartments.org. It is by the National Multifamily Housing Council that put this data together. And on this website, over the entire nation, by 2030, we're going to have a shortage of several 100,000 homes and apartments, and it's because of the demand for becoming a renter nation, the demand for apartments. And obviously this is market specific. So when we as a company are looking for markets to invest in, we look for markets, and one of the resources we use is that weareapartments.org, and it gives us a kind of an insight into what the next 20 or 30 years is going to do. And in the markets that we're investing in, there right now is a shortage and a higher demand for apartments. And so you have this high demand, low supply, which allows us to be able to increase the value of the property by increasing the valuation. And to give you a kind of quick example of how that actually works is if we have an asset that is it's called a booming market that has a 5% cap rate or capitalization rate, which on the next slide in a minute we'll get to that point and I'll talk about that. But when we go to a market that has a 5% cap rate, if we can have that asset perform better and do what's called a value add piece to it, it allows us to exit at a much higher valuation just by improving the efficiency of those efficiencies of the property. And so on that next slide, you can kind of see our process as a group and how we're trying to find underperforming properties that have this value add component. But to give you a quick example, if we take an asset and we increase the NOI, that net operating income on an asset, by $100,000, that $100,000, when we exit the property, because of that capitalization rate about 5%, we can now increase the value of that property by over $2 million. I won't say over, because if you increase it by $100,000, it increases the value of that by $2 million. And when we do our underwriting, we underwrite it by showing that we're going to enter at let's just give you an example. We're going to enter at a 5% cap rate market, but then we're going to project that we're going to exit at a 6% cap rate market. And that cap rate expansion is what we call when we go from a 5 to a 6. It basically tells us that we're projecting that there's going to be a softening of that market. Now, chances are it's going to probably stay around that really good and phenomenal piece. But when we're doing our underwriting, what we call our deal analyzing, we want to make sure that we are as conservative as possible. And that's one of the ways we do that, is we expand that cap rate upon exit. But even if we're to expand that cap rate upon exit, that same $100,000, instead of being a $2 million increase in valuation, it's going to be closer to $1.7 million in valuation. So it's still a very, very great increase in that valuation process. Now you can see here on the slide here that one of the things we do a lot of is we do a lot of sourcing of deals. We work with a lot of brokers. We work with a lot of people that have boots on the ground, experience in the various markets that we're in, and they're constantly every day sourcing deals. And then once we find a deal, say we analyze 100 deals, this is kind of what this slide shows. When we analyze 100 deals, we're going to fully underwrite about 30 of those projects that meet our criteria, the criteria that we set. which I'll go over some of that here in a couple of slides as well. But then once we underwrite a deal, if we feel like it still looks good, we still want to move forward with it, of those 30 that we underwrite, we'll submit offers on about 10 of those deals. And then of those 10 deals that we submit an offer on, we're going to acquire one of them because we're going to be able to win that bid and get awarded on it. So this is a lengthy process, and this is why, if you want to do this full time, you could. But, for those of you who have your self-directed IRA and you want it to be able to grow, faster than it is now, but you maybe be working full time, or, want to be working on this kind of stuff, or you don't have the experience level with it, that's where you want to find an experienced operator that is doing this for you, so you don't have to worry about it, and the returns are still phenomenal. Now, on the next slide, I want to go over a few pieces of terminology so that as you move forward into this multifamily investing space, you can have a better understanding of some of the terms that you're going to see. And so a couple of them on here I've already talked about, but the first one here is going to be this IRR, which you're going to see a lot of. And so that's the internal rate of return. Now, some of you might have heard of that before, and you might be thinking, oh, that's just the rate of return. That's just the return on your investment, the ROI. And that is not the ROI. It is akin to the ROI, and it's similar to it, but it's not. So give you a quick example. If I was to tell you that I invested $100,000 in a deal and then I got $200,000 back, would you say that's a good investment? Well, the answer to that is it depends. And, if I put $100,000 in today and I got $200,000 back a year from now, that's a phenomenal deal. But if I put $100,000 in today and it took me 30 years to get $200,000, then it's not a good idea. It's not a good deal. And so that's really where the internal rate of return comes into play. Because when you have longer term plays, when you start to talk about return on your investment, it's not really a very good indicator as to how well your investment is doing. So the internal rate of return bakes into the ROI the time component, the time value of money, so that whenever you put that investment in, how long does it actually take for you to recoup that initial investment, and then to actually make a profit on top of that. And so that's that internal rate of return. The calculation is a little bit complicated, and so it's usually done via a spreadsheet with Excel, or there's also some websites that you can go to and plug in some numbers. The gentleman on our team, Danny Randazzo, I think I mentioned him earlier on the webinar. He is a little bit crazy when it comes to numbers and spreadsheets, so he's actually broken this down and done it longhand before. I think because he really wanted to understand the formula. So if you like that kind of stuff, you can do it longhand, but it's a lot of calculation. So most people just use it with a spreadsheet because it has to do with when you invest it and at what points along the timeline you're actually getting that investment back. The next one here is cash on cash return. So if you put in, like we said earlier, if you put in $100,000 and you have a 10% cash on cash return, that means annually you're going to get 10% of your money back. It's that cash on cash return. Now the capitalization rate is similar to cash on cash, but it's different in the fact that it's only related to cash on cash if you paid full price, or you didn't use leverage on the acquisition. So if you have a $1 million property that you're buying and you're paying cash for that property, and you have a 5% capitalization rate, that means if I pay cash for the property, I'm going to make 5% return on my money. And at that point, you'd have a similar cash on cash return because you paid cash for the property. Now, the assets that we acquire, we acquire them with leverage, or what is called debt. And so when we put debt on a property, it allows that cash on cash return to be a little bit higher because of the actual debt that we're putting on it. And so we're not having to put as much capital into the project. And so the return on that allows that cash on cash to be a little bit higher. Now, the capitalization rate is how you value and how we're valuing a property in a market, and it's based off of the NOI, the net operating income, and the purchase price. And so when you start to figure out each market, every market's going to have a little bit of a different cap rate, but the way it's calculated is you take your net operating income and you divide it by the market cap rate, and that's going to give you the valuation of that property. That's why when you take that the earlier example that I talked about, you have that $100,000 increase in the valuation, increase in the net operating income. You take that $100,000 and you divide it by that 5% cap rate. That gives you that increase in valuation of $2 million. So if you want to do that right now, you can pull your calculator out, take $100,000, divide it by 0.05, which is that 5%, and press equals, and it'll be $2 million. And so you can kind of see how that calculation works when you're trying to figure out what is going to be the purchase price on a particular asset. Now, the next thing here is debt service. So debt service is going to be your mortgage payment, including that principal and interest. And the reason why I feel like you should understand debt service as a passive investor is that it allows you to understand how over or under leveraged a property is when you're starting to talk about the next thing here, which is the debt service coverage ratio. So that debt service coverage ratio, when you're looking at a project, you want to make sure it's over 1. So when you talk about the debt service coverage ratio, the debt service coverage ratio, when it's 1, it means you have enough cash flow or enough income on the property that you can at least meet the debt service, but no profit over and above that. So most lenders are going to want to see that about 1.25 or above, and it also depends on the market. So some markets that are a little bit lower markets, they're going to want to see 1.3 or 1.35. And unless you go into what's called a bridge loan, which is a whole other topic, which I won't go into today, but the bridge debt allows you to acquire property when you have less than 1 in debt service coverage ratio, as long as you put some money back in reserves and you have a business plan in play and you have something that you're doing on the property. Then the last thing I want to talk about today is this non-recourse debt. The nice thing about these assets, because you might be thinking about this going, well, if I invest in this project, am I going to be liable for anything that happens on the property or anything that goes wrong? And the answer to that question is or even if the asset, the operator doesn't perform well and the bank has to come back and take the property and they default on it, are you going to be liable for that? The nice thing about this as being a limited partner in these deals is that the only thing you are risking is the loss of your initial capital investment. They can't come after you for more than that. And when you have this non-recourse debt, the non-recourse debt is usually used which is called agency financing with Fannie Mae or Freddie Mac, and they allow non-recourse debt on here, where when you normally like buy a home, you're going into and you're signing a loan, saying that you're going to be personally guaranteeing the debt. Well, the only people that have to sign on the loans on these are the operators. So there'll be our 3 partners, our group are the ones that are signing on these loans, and we're signing on what is called non-recourse debt. So at the end of the day, if something does happen with the property and they have to take it back, they don't come after anybody. They just take the property back. So that's one of the
Hey,
things that go ahead.
I was gonna say, Dan, I had a quick question just before we move on, and again, encourage anyone who else has listening
Sure.
have questions to ask. The IRR, the cash on cash return, the cap rate, are these the information on this? Is this, if an investor is looking at a syndication, is that something that they will find in like the prospectus and the private placement documents, or is this just kind of where would someone look for where to find out what these rates of return are going to be, what the debt service coverage ratio is, et cetera?
Yes, that's a great question. And so, if you've built a relationship with a group like ours, and you're on our investor database or you're in our investor list, then whenever we have a project that's available for investment, we will send out in a what is called an offering memorandum. And in that offering memorandum, this information will be listed out. We'll have that. What is the internal rate of return? What's the cash on cash? What's the cap rate? And on the next slide, I'll go over some of the numbers that you should be looking for as a passive investor. And it's what our group looks for as well when we're putting deals together. So that's a great question. But whether you are looking at deals from our group that we've put together to possibly invest your money in, or you're looking at other syndicators, they will give you this information in an offering memorandum, but you have to make sure that you get on their list in order to be able to be sent this information, because a lot of investors, a lot of these syndicators are doing what is called a 506B SEC registration. So all these are registered with the SEC, and so there's certain regulations as to who they can and cannot advertise to. But some of them are doing it under different regulations, like a 506C, which allows them to advertise them. But I don't want to confuse you and get you into a long conversation about SEC requirements, because I could do that because I have quite the knowledge on that as well. But biggest thing to understand here, Scott, is that all of these numbers should be presented to you when you're prior to you making a decision to actually invest in a project.
Yeah, we had another quick question pop up. Someone said debt service does not include taxes and insurance, correct? Is that correct?
No, that's correct. It does not include taxes or insurance. The debt service is just the mortgage payment with the principal and the interest. And so a lot of these projects will have interest only for the first couple of years. And so the debt service though still includes the principal and the interest payment. So when a bank is looking at this, like Fannie Mae or Freddie Mac, and they're looking at that debt service coverage ratio, they want to see it being 1.25 or above. And when the interest only period stops. So they're not just going to look at just the interest only period. They're going to say, all right, in 3 years when the interest only period is up, are we still hitting that 1.25 if everything was to stay the same? And so that debt service is just the principal and the interest. Now the taxes and the insurance that we're referring to, that would be off of the expenses off the property, and so that would be taken off when you're calculating your net operating income, because that net operating income is taking the income off the property, minusing your expenses, and that's going to be your net operating income. And then your debt service comes off of your net operating income for you to know what your cash flow is going to be at the end.
And just one more quick question before I'll jump to the next slide after this one. Someone said, what are the components of the debt service coverage ratio? Is it NOI divided by debt service? I guess that's what they were looking for in that regard.
Yes, that's correct. So it's not really divided by, it's actually I guess so it's actually going to be your net operating income uh divided by your actual debt service. That's going to give you whether or not you have that 1-to-1 ratio or the 1.25. So if we just take a quick example here, and I'm just going to pull my calculator up here. I don't have it on the screen, but if you take your calculator here and you take, say, $100,000 in income, and you divide that by, let's see, you take that and you divide that by $100,000, that's going to be a 1-to-1 ratio, right? But if you have, let's say you have 125,000 in cash flow and you have your debt service of 100,000, that's going to give you that 1.25 debt service coverage ratio. And that's basically an indicator that lenders look at, and when we're underwriting the deal, to see, is there enough money left over after we pay the debt to pay back to be able to take back and pay back the investors. And so that's one of the things we're always looking for is there enough money after from the income minusing the expenses and then minusing the debt service to allow the deal to still make money for the investors.
All right, cool. Well, thanks for answering those questions. We'll move on to the next slide, and then if anyone else has other questions, please get them typed in. Hopefully we'll have a few minutes at the end.
Great. So the next slide here is going to be about some of the targets that you should be looking for when you're investing in a multifamily syndication like we're talking about here. So the age range of the assets that we look for are going to be in this 1980 to 2005 age range, and there's a couple of reasons for that. Number one, when you start to go prior to the 1980s, you start to get into higher maintenance projects, and you also start to get into some other things like polybutylene piping and aluminum wiring and a possible asbestos into the property, and those can be very costly. And so we stick with 1980 to 2005 builds, which allows us to have a lower maintenance property, but that also allows us to buy a property that has some interior renovations that need to be done. There's might be some deferred maintenance. They're in that BC value add a property that we're looking for. The next thing is that cash on cash return. So we're looking for that 9 to 11% on a 5 to 7 year hold. Most of the time, we're looking at a 5-year hold. And again, it's because of that front loaded depreciation that you have on it as well, for those of you who are interested in investing with just through cash versus your self directed IRA. The next target here, or the criteria, is your IRR target. So right now, we're targeting 15 to 18% on a 5 to 7 year hold. But as they continue down into the market, there's this question of, is there going to be another correction in the market or downturn or whatever? And so those return numbers are going to most likely go down. They might go 12, 13, 14%. But right now we're looking for 15 to 18%. And so far we've been able to do that on our projects and do really well with them. And so I would encourage you to look at that IRR number and see, is it in that range of that 15 to 18%? It could be higher than that, obviously, but when you start to look at a deal that has, 25, 30% IRR, you start to scratch your head and go, something seems a little bit too good to be true, right? So it's obviously not that conservative of a deal if they're being pretty aggressive with it and they're getting those large numbers. Now, it's always nice to hit those numbers if you exit a deal and you can hit those kind of those return numbers. But you always want to make sure that you're looking at the next target, which is your equity multiple. That equity multiple needs to be about 1.9 to 2.1x, somewhere around in there, on that 5 to 7 year hold. Now, obviously, if you're going to 7 years, you want it to be closer to 2.3, 2.4. But really, on that 5 year hold, you're looking at on the low end doing 1.9 upwards to about a 2.1 equity multiple. And again, these are the criteria you're going to look for on the projections prior to investing in one of these multifamily syndications. So it could be much better than this whenever you actually get into the deal. Just depends on which operator you have doing it and can they actually execute on that plan. And then the other thing that I would tell you to focus on is, after looking at those four things above, is to focus on that entry and exit cap rate. We talked about the cap rate earlier, about how important it is to utilize that cap rate to your advantage by increasing the net operating income of a property to be able to increase the value of the property as well. But when you're doing underwriting, it's always a good idea, and when you're analyzing a deal or when you're looking at a deal that has been analyzed that you're about to invest in, and see, is there some expansion or some increase of the exit cap rate? That's whenever you sell the property, are you exiting or projecting that you're going to sell the property at a higher cap rate to show that it's a more conservative deal? You're going to show that the market might be a little bit softer when you exit a deal than when you entered it. And so one of the things that we use as a rule of thumb, and I would suggest that you write this down as well, is that you want to have and see at least a 10 basis points spread or expansion on that exit cap rate from the entry cap rate. So to give you a quick example of that, when you talk about a 5% cap rate market, when you enter at a 5% cap rate and you're in it for 5 years, you want to see on the underwriting that they're projecting it to be exiting it at a 5.5% capitalization rate. And that shows you that they're exiting at a softer market than what they entered. And so in addition to that, you want to see a sensitivity analysis. That sensitivity analysis allows you to see, as you increase or expand that cap rate, what does that do to the IRR and the returns? And so that's one thing that our group always does, is to see if for some reason we have to exit at a lot more or a lot higher capitalization rate than what we entered, what does that do to our return numbers? And are we still comfortable with it if it goes a little bit higher than what we're projecting? And then the last thing I would encourage you to do is know the sponsor. That's one of the reasons why, I try to jump on with groups like Scott's group and, Advanta IRA is to get people to know us as sponsors and let them understand who we are and get to know us a little bit more so they can start to like us and start to be able to trust us and be able to invest with us. Because we have a lot of people that invest with our projects. And one of the things I always strive to do is try to get people to understand who we are so they can know, like, and trust us. And so if you're interested in having a conversation a little bit further, you can go to our website there, thepassiveinvesting.com, and there's a simple form on there that you can fill out. When you fill that out, I'll jump on a phone call with you, discuss what your goals are, answer any further questions that you have, and I want to get to know you a little bit more as well. And so I like to know all of our investors on a personal level, and so I personally jump on the phone call with all of our investors so we know exactly who they are. And so let's open it up now, Scott, to some questions here. That last slide is just the questions. So is there any questions that have come out?
Yeah, we actually had one question. It was for me. I'll answer it quickly, asking about whether or not is there any way to get a current 401k with a current employer over to a self-directed IRA without penalty? And the answer to that question is it depends. When you work for a current, when your 401k is to your current employer, you have to check with the administrator of that plan to see what availability you have to move it. Now, each 401k plan can be a little bit different. Some of them will allow you to do what's called an in-service rollover while you're still employed there, but you have to check with the plan. Now, I can tell you for individuals over the age of 59 and a half, almost universally, once you reach that age, you can do a rollover, even if it's with a current employer. But if you're under that age, you need to check with the administrator of that particular plan. Question for you, Dan. Are you using IRA funds to raise capital for multifamily deals? I think the answer is obviously yes, but I'll let you speak a little bit maybe on how much of that you see.
Yes, we are. We see that in every one of our deals that we have. I will say that it can be rather challenging for some IRA companies, which is why we like to align with groups like Advanta and recommend them, because they do a very streamlined process, which makes it easy for us as sponsors to be able to allow IRA investments into our group. And so, you want to make sure that you choose the right self-directed IRA custodian, which is one of the reasons why we like working with Scott and his group, because they do have that streamlined process. Makes your life easier as a IRA account holder, but also for us as sponsors and allowing you to be able to invest in our projects. And one thing I didn't mention, which I'll just mention it now, is that you don't have to have hundreds of thousands of dollars to invest with your self-directed IRA in some of these projects. The nice thing about a self-directed is you can invest in multiple projects. And so the minimum investment on our deals is usually $50,000. Every once in a while, we'll do a deal where it's a little bit more than that, but most of our projects are minimum investment of 50,000.
All right, good. That answered one of the questions that we had too. So we asked what the minimum amount was. Someone asked, is the exit cap rate? So the question was, is exit basis point improvement due to value adds at beginning of the project or for other reasons? But I think they meant to say exit cap rate is what they mentioned. If that question makes sense, Dan, what I just read.
I think what they're trying to say is maybe why would you expand the cap rate upon exit? And it doesn't mean we're going to sell it at that cap rate, but it means that when we're trying to project our numbers, we want to be conservative in our analyzing of the project and our underwriting, and show that the market that we're entering might be a little bit softer when we exit it, even though we might be really bullish on the market and might think it's going to be doing really, really well in the next couple of years. It's always a good idea when you're trying to project your numbers to say, hey, this market might not be doing so well, or might not that it might not be doing well, but it might not be doing a 5 cap rate at that point. It might be doing a 5.5 or a 6. And so that's really where that expansion of that cap rate upon exit is coming from, is just to be as conservative as we can when we're underwriting it. Because as a syndicator myself and a sponsor, I want to make sure that I can overpromise. I can underpromise and overdeliver. Right? I don't want to tell you that I can get you 3 times your money, and then you invest with me thinking you're going to get 3 times, and I only give you 2 times. I would rather do the opposite. I would rather say I'm going to get you 1.9 to 2.1, and then really outperform and get you like 2.5 or 3. And then you just love me even more, right? You want to put as much money with our group as possible, because you can perform, and that's what our investors like. Is they like knowing that their investment is safe, and they like knowing that they're going to be able to get the returns they're looking for when those projections come out from our group. Because I have seen some other groups that have put projects together, and their returns are not hitting the targets that they're projecting because they're a little bit too aggressive with it. And so you want to make sure that you align yourself with a group that does have that conservativeness when they're underwriting the deal.
Yeah, just a few more questions and we'll wrap up. Someone mentioned kind of how a lot of your portfolios are consist of properties with 100 plus units. Do you think that's a sweet spot for units per property? Is there a particular reason why a lot of your properties are 100 units and more?
Yes, so that I would say that the reason why there are 100 units or more is because of the safetiness and the stability of the assets when they get over that number, but also because you have a greater opportunity for improving that property based on the economies of scale. And so one of the things that you have to look at one of the things that we look at when we're acquiring a property is if we drop below 100 units, we are going to still have to have on-site property management. And so we use third-party property management companies, and they have on-site staff. Well, when you start to go down to 30, 40, 50 units, it's hard to have somebody work full time on that property because the numbers just don't support it. And so you start to get into this little weird quandary of being able to afford it, but also try to keep it stabilized. And so our group likes 100 units or more. Preferably, the sweet spot for us is right around about 130 to about 160 units. You want to have a minimum 130 to 160 units to be able to take advantage to be able to take full advantage of on-site property management. And one of the things that our group does as well is that we try to acquire assets that are close to each other in similar markets or in close markets so that we can use economies of scale when it comes to having multiple properties. So a lot of times you can have two full-time maintenance people that rotate between two properties instead of having to have two on one property and two on another. And so you can have this economies of scale, which again, when you can start to reduce the payroll and reduce expenses on a property, it also increases that NOI so that you have a better exit as well.
All right, two more questions. One is, do you use or promote a waterfall distribution structure?
Okay, so that's a great question, and for those of you who aren't familiar with that terminology, it's a waterfall or hurdling, if you will, basically is saying that once the investors get a particular return, then that the money rolls over to the next bucket, if you will. So it's kind of where there's water filling up buckets, and then once it fills up that bucket, it rolls down to the next bucket, right? And so our particular projects, we do what's called an 8% preferred return to our investors, and then we do a 70-30 split. And on some of our projects, we also do what's called a secondary hurdle or a different, it's basically a waterfall, but we call it a secondary hurdle where once we achieve that 18% IRR return target for our investors, then the ownership changes from 70-30 to 50-50 for anything over 18%. So it basically incentivizes the sponsor or the operator like ourselves to continue to outperform and to continue to hit those targets as best we can, because we know at the end of the day, if we can do that for our investors, and our investors know that if we can continue to perform that, we'll be able to have a higher upside as well. So it's all about aligning the interest of the investor, but also the sponsor at the same time. So great question. Yes, we do use waterfalls, but we try to keep it simple as possible. But we feel like that's the best way to align the interest of both the sponsor as well as the investors.
All right, great. Last question, Dan. For someone investing personally, can they 1031 their on the exit of the project? Can they 1031 their personal ownership, into another property and continue the tax deferral on a personal basis?
So that is something that is deal specific, and so it's a great question. But yes, we do consider that, and yes, we do do our best to be able to have that happen. But I don't recommend anybody banking on that whenever we try to exit a property, because number one, the tax laws right now are changing quite a bit, and that might change between now and then. That might not be an opportunity that we have available to us. But yes, that is something that we do consider and we will consider, and that will be done once we have that conversation to be able to exit those deals.
All right. Well, Dan, thank you very much again for your time today. Great presentation. I'm sure everyone that was on today learned quite a bit. Thanks again, and maybe we'll have you on again soon.
Yeah, sounds great. I appreciate it, Scott.
All right. Everyone who's listening, again, thanks for logging in, and we'll look forward to having you on our next event.